Good afternoon. I want to thank you everyone for joining us this afternoon for our committee's virtual forum. And I especially want to thank the panelists for being with us here today. On March 27th, the CARES Act was signed into law. The act created the Paycheck Protection Program as a sub-program within the 7A loan guaranteed program and provided it with almost 350 billion for fully guaranteed forgivable loans designed to meet payroll costs and other business expenses. The goal of the program is to save as many small business jobs as possible as quickly as possible. As of May 8th, New Jersey small businesses received a total of 124,489 loans totaling almost 18 billion, helping to save thousands of jobs in my home state of New Jersey. And given the size and the scope of the PPP and the speed with which it was stood up, implementation was bound to be less than perfect. And we appreciate all the hard work by everyone at SBA and are equally grateful for your commitment as lending partners, helping small businesses stay afloat during these uncertain times. With that said, we are tasked with assessing areas for improvement. And the first round of Paycheck Protection Program funding exposed some of those areas. For example, too many Main Street mom and pop shops were forced to sit on the sideline as the program was first rolled out, while larger, better capitalized businesses received loans. All they were left with was the hope that Congress would add more money to the program. Eventually, Congress did. On April 24th, Congress provided an additional 310 billion in PPP funding with a set aside intended to funnel a greater portion of the funds to underserved business communities who struggled with access to affordable capital. This second round of funding is also expected to lapse soon, and while the account didn't draw down as fast as some expected, in part, I suspect, because of the lack of clear guidance with the forgiveness rules, I expect America's small business community will seek additional funding. That makes today's forum a timely one, as we will be able to hear from stakeholders about what's worked with the program, what hasn't, and how Congress can keep optimizing it, and whether Congress should look outside the PPP for more capital access solutions for small businesses struggling with the coronavirus pandemic. Again, I want to thank the panelists for joining us here today, and I now yield to Ranking Member Hearn for his opening remarks.
Thank you, Mr. Chairman. The COVID-19 has ushered in unprecedented times. As a small business owner myself for the last 35 years, including working on bank boards and McDonald's National Leadership Team and others, I feel like I'm pretty deeply connected to what's happening based on so many calls that I've been on across the country with literally hundreds and hundreds of small business people on various calls. When small businesses and their employees are not at work, our economy suffers, and our country has gone from one of the best economies on record to double-digit unemployment numbers in a matter of just a few weeks. At the federal level, we're fighting back against this crisis, and a little over a month ago, the president signed the Corona Aid, Relief, Economic Security Act, also known as the CARES Act. And within that legislation, Congress created the Paycheck Protection Program. And this program created forgivable small business loans as long as they were used on payroll costs and other related items such as mortgage interest, rent, and utilities. With the crisis growing by the day and small businesses being forced to shut down due to no fault of their own, the SBA and the Department of Treasury was charged with setting up a program at light speed. The timeline to write regulations and guidance was shortened from months to days. In fact, the Small Business Administration did approximately 15 to 20 years worth of work in relatively 5-6 weeks. It was truly an unbelievable task, and we should give these agencies credit for moving with such speed and such accuracy for what they had to do in such a short period of time. The focus then shifted to private lenders that were charged with executing this massive program with speed, agility, and confidence. And again, lenders met the challenge. We should acknowledge the time and energy that was required by lenders to decipher rules and regulations and translate it into capital for small businesses. However, as the chairman mentioned, there have been road bumps and turbulence that have developed during this process. The SBA and the Treasury published guidance late on a rolling basis, and they published rules that have changed midway through the process. This has caused great confusion, not only for our lenders, but also for the small businesses. To date, the SBA and the Treasury have still not published much needed back-end loan forgiveness guidance. Having complete and comprehensive rules and regulations is instrumental for our business decisions. Guidance is just one of the many items that I hope we can discuss today. Additionally, I'm looking forward to hearing about the improvements that Congress should examine and debate when it comes to the Paycheck Protection Program. And finally, as it starts reopening again, it will be important for Congress to also study what recovery looks like and what opportunities we can have as we have a rolling opening across the country. I think it would be prudent, and I'm working on a letter right now to go to Treasury and SBA, that if businesses, as they see their businesses opening up, want to bring back the money sooner than having it turned out in a loan, that money can be reauthorized and reappropriated through the PPP loan program. And just to give you the magnitude of that number, if there's 4 million loans and $10,000 average came back, that's $40 billion that could be used currently in the PPP program to help other small businesses that may have not gotten into the first or second tranche. So, Mr. Chairman, I want to thank you for gathering us all today, and especially want to thank you, the lenders, for joining us. And with that, Mr. Chairman, I yield back.
Great. Thank you, Ranking Member Hearn. I always say it's great to be able to work with you on this, and your expertise and your experience with small businesses is important now more than ever. And I think, continuing to do the work that we've done together over the last year and a half or so, of just continuing to show that the work that we're trying to do here on this committee is bipartisan. And right now with this crisis, that is more important than ever, that if ever there was an issue that we need to be working on in a bipartisan way, it's about saving our small businesses, helping out in every way we can to be able to help them get through this crisis. So thank you again. I just want to take a minute here to just talk through some of how we're going to be moving forward on this. So, each panelist will have 5 minutes to provide a statement, and then each committee member will receive 5 minutes for statements and questions. Just please ensure that your microphone is on when you begin speaking, and return it to mute when you're finished. And we're going to do our best to try to abide by these timetables here, but given the fact that we're doing this virtually, we're still working through some of these aspects here. So with that being said, I want to just thank our panelists for taking time out of their busy schedules to join us. And with us today, we have Mr. Tony Wilkinson, President and CEO of the National Association of Government Guaranteed Lenders. Thank you. Ms. DAFINA Williams, Vice President of Public Policy for the Opportunity Finance Network. Mr. Brett Palmer, President of the Small Business Investor Alliance. And Mr. Jay Hanna, Vice President of Financial Services for Bank First Bank. Thank you all for being here today, and again, for giving us your insights into the situation. We look forward to hearing from you. I'd like to begin with recognizing Mr. Wilkinson for 5 minutes. So Mr. Wilkinson, over to you.
Thank you, Mr. Chairman, and hello again, Mr. Hearn. Good to see both of you. Thanks for inviting me today. When the CARES Act was signed into law, SBA lenders immediately stepped up to meet the challenge to provide financial assistance to help small businesses survive. To date, participating lenders have received approval for over 4.3 million PPP loans valued at over $533 billion. Despite this phenomenal performance, there have been major failures in implementation, and here are just a few. First, I'd like to address the lack of clear implementation guidance. On the very day PPP loans were first made available, SBA's Office of Inspector General issued a sobering white paper noting how essential it is to have clear guidance before loan funds are dispersed under programs like PPP. Clearly, Treasury and SBA did not heed that warning. Today, not one participating lender knows how to make a loan from start to finish. Instead, they have issued PPP guidance on a rolling, piecemeal basis by way of 9 interim final rules and 46 frequently asked questions, with more still to come. This isn't an appropriate way to implement a program under which hundreds of billions of dollars of loans are being made. A case in point, Treasury and SBA still have not issued guidance regarding how the forgiveness process will work. This leaves borrowers and lenders uncertain about whether their loans will qualify for forgiveness, even though borrowers have been given only until tomorrow to decide whether they should cancel or repay their approved PPP loan. This lack of guidance is also a violation of the CARES Act, which required promulgation of forgiveness regulations within 30 days of enactment. And today is day 46. Think about this. A program designed on the premise of forgiving loans still has no process by which to forgive those loans. The second major issue is the criticism regarding the very small percentage of loans over $2 million. When the architects of the program set the maximum loan size equal to 2.5 times the applicant's monthly payroll costs and authorized a maximum loan size of $10 million, double the standard 7A maximum, it was clear that the intent of the program was to also assist businesses with larger payrolls supporting more employees. This is further supported by the fact that the statute allowed more businesses to be considered small than under SBA's traditional size standards. And the statute specifically eliminated the requirement that SBA's traditional credit elsewhere test must be met, and only required that the loan applicant certify that the uncertainty of the current economic conditions makes the loan necessary to support the ongoing operations. But of course, there is no definition of the word necessary. Based on the statute and original guidance, applicants and lenders believed in good faith that they qualified for PPP loans right up to the point where they were criticized in the media. And in response to that criticism, Treasury issued FAQ number 31. That FAQ imposed a new self-test requiring borrowers to consider their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations. A test that sounds an awful lot like the credit elsewhere test that was specifically excluded from loan eligibility. News headlines focus on the larger loans, but less than 0.8% of PPP loans are $2 million or over. Evidently, the fact that the vast majority of loans are for $50,000 and under does not make for splashy headlines. If the Congress and administration wants to fine-tune the public policy purpose of the program, then clearly define what is expected for any future extensions of PPP. But borrowers should not be shamed or threatened for doing what the law invited them to do, obtain PPP loan funds to help them continue to meet their payrolls. Finally, CARES Act continues today without necessary fixes that the lending community has pleaded for. Not just much needed technical fixes to make PPP better, but also one fix in particular necessary to correct a serious error that combined the PPP and the regular 7A loan program's authorization cap. The most troubling unintended consequence is that if the joint authorization level is reached by both PPP and 7A prior to June 30th, the 7A loan program may shut down. Congress needs to reinstate the already agreed upon fiscal year 20 7A loan program authorization cap now. And if the administration thinks they can fix this by reserving a portion of the joint authority for only 7A use, they need to formally communicate that as soon as possible. In some ways, PPP, as implemented by Treasury, has set up lenders to fail. But instead of failing, lenders have risen to the challenge. Thanks to their efforts, millions of small businesses are receiving the help so critical to their survival. Have there been discouraging headlines? Yes, but they have been more than balanced out by the countless messages of hope and gratitude that borrowers have sent to their lenders. These messages describe how PPP loans saved their businesses. That is why PPP matters and why lenders continue to strongly support this program. Thank you, and I look forward to answering your questions.
Thank you so much, Mr. Wilkinson, for your insights into this. I'd like to continue on. Ms. Williams, you're recognized for 5 minutes. Over to you. Thank you.
Hello, good afternoon, Chairman Kim and Ranking Member Hearn. Thank you so much for the opportunity to be here today. My name is DAFINA Williams, and I'm Senior Vice President of Public Policy at Opportunity Finance Network. We're a network of nearly 300 CDFIs, community development financial institutions, mission lenders focusing on lending and investing in low-income and underserved communities. We reach communities that other lenders do not. Our borrowers are 85% low income, 58% people of color, 48% women, and 26% rural. Starting in mid-March, OFN started to hear from the business lenders in our network that they were seeing a lot of stress on their borrowers, especially restaurants, hair salons, food trucks, gyms, and other businesses in recreation and tourism, seeing their revenues disappear almost overnight. These businesses are important contributors to local economies and job creation, but have common challenges: smaller revenue size, limited relationships with traditional finance, and relying on family and credit cards. Their profits were already tight before COVID-19. Major economic shocks like this can be devastating, and these are also industries with heavy concentrations of business owners of color. CDFIs responded right away, modifying loan terms, providing flexible repayment arrangements, and doing whatever it takes to support these business owners. And they were excited to become lenders under the Paycheck Protection Program and provide access to these new resources. Unfortunately, things got off to a rough start under the first round of PPP funding. The first efforts at relief really failed to address the needs of small, women, and minority-owned businesses, mostly because that lending activity initially was through banks, and many small businesses lack banking relationships. CDFIs were seeing demand for PPP loans, but the path to becoming a lender had high barriers to entry for non-depository loan funds not already participating in the standard 7A program or the Community Advantage pilot program. The PPP regulations were not designed to encourage CDFI participation. The $50 million annual loan volume threshold was too high for most small business loan funds to meet. Non-depository CDFIs were also initially locked out of the Federal Reserve's PPP facilities to purchase loans, preventing access to critical liquidity. And while the SBA, of course, faced huge challenges standing up a brand new program and to get this money out of the door in such a short amount of time, and what they've accomplished has been truly impressive, there have been consistent challenges with communication from SBA and Treasury. Numerous changes to the interim rule, delayed issuance of critical guidance, and confusion for both borrowers and lenders, resulting in the loss of critical time to help business owners. In spite of these challenges, CDFIs have been able to make a big impact on the program. 302 CDFIs have made more than 50,000 loans totaling $2.8 billion. OFN surveyed our members that are participating in the program and heard from 35 of them that even with capital constraints, a challenging regulatory environment, and no liquidity from the Fed, in round one, 35 CDFIs made more than $1.1 billion in PPP loans in just 6 weeks. Loans to nonprofits, food service businesses, barbershops, hair salons, ranging from $11,000 to $160,000. The average loan size was $53,000, and businesses had about 7 employees on average. But our impact could have been even greater if CDFIs had a clear on-ramp as lenders, especially given that we are already partners for the federal government to reach underserved communities in multiple other federal programs. We have been pleased to see improvement in the second round of PPP. We have greatly appreciated the Congress and this committee's recognition of the need to direct funds to underserved businesses. The $30 billion carve-out for community financial institutions in round two was also key. It was important for CDFIs in the program, but also an important signal to SBA and Treasury to take the needs of underserved businesses seriously. We found that our borrowers need technical assistance even just to get their applications ready. They don't have lawyers or accountants on hand to really help them. CDFIs also had trouble getting their loans into the E-Tran system when there was so much traffic taxing the system. The window that SBA opened for small lenders a few weeks back was welcome and helpful. It allowed CDFIs to really access the system when there were still many logjams. We've also been pleased to see Treasury and SBA update the interim rule to drop that loan volume threshold for non-depository lenders from $50 million to $10 million. And the Federal Reserve also opened access to PPP for non-depository CDFIs, which will help with liquidity. So as things do improve in the second round, OFN does have recommendations to ensure better implementation and increase access to small businesses that need assistance most. We were pleased to see some of these recommendations put forth as part of the House stimulus bill released yesterday. We're very pleased to see a set aside for CDFIs, MDIs, microlenders, and CDCs. Also, a proposal for a set aside for very small businesses and nonprofits, both groups that CDFIs serve that had a hard time getting in. We have heard growing concerns from business owners about a few things. Greater clarity on how to qualify for the loan forgiveness and to ensure that their paperwork is correct. Many business owners are concerned about piling on additional debt. The 8-week time period that might not be long enough for many businesses to actually rehire their staff and reopen. The need for some flexibility on the 75-25 split for payroll expenses. And we're also pleased to see the bill call for better and more complete data collected on borrower demographics to determine where the funds are going. Collecting that data will provide a clearer picture of PPP's reach. So as I close, I want to thank the committee again for your efforts to improve PPP. And the federal government really has a critical role here to make sure that small businesses survive. PPP is a short-term solution, but the damage from COVID-19 will need to be addressed on a much longer basis. For CDFIs, our industry will continue to provide access to capital and adapt our business models to adjust to the new normal, but we need additional capital and capacity to meet those borrower needs. Business finances will not look the same after this crisis, and we all must be nimble and adjust our financing strategies to reflect this. Nonprofit loan funds in particular need equity capital to be able to lend both through PPP and for the longer-term recovery. The most important source of that capital is through earned revenue and grants from the Department of Treasury's CDFI fund. It is critical that we have a $1 billion appropriation to the CDFI fund for these grants, and we were extremely pleased to see that level of funding included in the House stimulus yesterday. That institutional level of capital will enhance our capacity to support our most vulnerable businesses and communities. CDFIs are proud to be a critical part of our nation's response to the economic challenges facing our communities. And I look forward to working with you and answering your questions. Thank you.
Great. Thank you so much. I appreciate that. Thank you, Ms. Williams. Mr. Palmer, over to you. You're recognized for 5 minutes. Thank you, Mr. Palmer.
Thank you, Congressman. My name is Brett Palmer. I'm president of the Small Business Investor Alliance. We're a trade association of small business investors. These are rural business investment companies. These are small business investment companies. These are small venture funds and small other funds, private funds around the country that are providing growth capital to our most dynamic businesses across the country in both commonly served areas and underserved areas. As we're speaking today, there are tens of millions of Americans who have lost their jobs or in fear of losing their jobs. There are millions of small businesses that are under severe stress and don't know if they're going to make it. But this committee and this Congress, working in conjunction with Administrator Crons and the SBA, have acted in a collaborative, bipartisan way to create a fund, a lifeline, the Paycheck Protection Program. And the country needs more of what this committee has already produced: collaborative, bipartisan, practical solutions support small businesses and create and sustain American jobs. We're going to discuss the problems with the PPP program and how to address them. You've already heard some of them. It's important not to overlook the success and the benefits of what the program has produced as we're looking at continuing policies or creating new policies. There are tens of millions of Americans who are now employed who otherwise wouldn't be. There are millions of Americans who still have health insurance that otherwise would not be able to afford it. There are millions of American families that still have a breadwinner. There are many, many small businesses that will now survive because of the actions and collaboration of this Congress and this SBA. The success of the Paycheck Protection Program means that many small businesses, which are the growth and employment engine of the economy, will have the chance to reinvigorate the economy once this economic stoppage is over. The fact that of the two biggest problems, one is that demand has outstripped supply, is a statement that the small businesses emphatically agree that this lifeline was needed and that you've done the right thing. The second biggest problem you heard from Tony, and he's gone through that in great detail. I would just reiterate exactly what he said, so I won't repeat it. But he nailed it. If there were historical comparison to what the situation we're in right now is, it wouldn't be the financial crisis and it wouldn't be a deep recession. This is a small business survival mission that could be compared to the evacuation of Dunkirk. And history does not look back at Dunkirk with complaints about the bumpy ride or people getting splashed. It's remembered as everyone doing their part to really give of themselves and save lives, and is doing so change the world. PPP has some bumps in the road in starting out. It's a massive undertaking that went from 0 to 500 miles an hour in no time flat, but it is saving small businesses and it's changing lives. And Congress should be proud of the votes they've taken for the PPP, and the SBA thanks the committee and the SBA for working collaboratively and thoughtfully to create this as quickly as you have. The PPP, as written in statute, works. However, defeat can be snatched from the jaws of victory if there isn't regulatory clarity and if small businesses are scared away from accessing the program or using the program to keep their low and moderate wage employees paid and their small businesses intact. As Tony highlighted, PPP needs more regulatory clarity. Small businesses are genuinely being scared off from using the money to retain their employees because this undefined, unclear liquidity elsewhere test that is nowhere in the statute. This needs to be addressed immediately. There are businesses that got money from the PPP that were going to use it to keep their employees employed, that gave the money back and laid off their employees because they were scared off from doing so. There are a number of them that paid their employees and kept their employees that they would otherwise have laid off and gave back the money because of this confusion around this liquidity elsewhere test. So now they're in a worse position than they were before, and that's not right. We certainly need the forgiveness rules laid out. Those are long overdue. Small businesses, in many cases, have gotten the PPP money, but they don't know what they're allowed to do, and they can't take any more debt. They need to use this in a way that is clearly going to be forgiven, so that they're not taking on more debt when they certainly can't handle more debt. And so they need to be able to operate off that. And so right now they're frozen. And right now we really need to unfreeze the economy and use that capital. You've done the hard work now. They just need to know how to do it right, because they really are acting in good faith. And one thing that is worth considering, and I know this is a little bit difficult, but as this program was started up and as businesses applied for PPP loans, we were at the front end of this economic hurricane. We didn't know how long it was going to last. We just knew it was going to be severe and brutal. And it has been severe. It has been brutal. But businesses in many cases have taken loans, and they now know a little bit more about what their condition is, about how the economy is shaking out. And in some cases, they can give some of it back. They don't need all of it. And so one thing, and this may be practically difficult, but it's worth considering if there's a way to make it work, is to allow businesses to return some of that capital so that that capital can be returned and used for other businesses, because they don't need all. It shouldn't be all or nothing. And it's also worth reminding that remembering that we're in the first inning of this economic and biological disaster. We're only experiencing the first wave impacts, of which PPP has done a very good job at mitigating some of those first wave impacts. But as you referenced, Congressman, there are going to be second and third wave impacts that are coming. And a whole lot of those impacts, we don't even know what they're going to be yet. And so this committee, the country really needs this committee to continue to do what they've been doing, operating in a nonpartisan way, coming up with practical solutions and advocating on behalf of small businesses, making the PPP program work, but also start looking now while we have the time at what is it we can be doing now to get the government infrastructure in place so that we have the tools in place that businesses are going to need 3 months from now, 6 months from now, 9 months from now. And do we have a government that can fill those needs? So we clearly need to get SBA fully funded. They need to be able to hire quality employees. They need to be able to reinvent their IT infrastructure, which has been really a restricting factor in making a lot of these programs work. We need to be able to have tools for these small businesses going forward. And the other witness mentioned equity capital. One of the things that I think you're going to see a lot of small businesses need coming out of this situation is patient capital. Businesses are going to be unbankable. They're going to be up to their ears in debt. They're going to be rebuilding their workforces. They're not sure how their accounts receivable are going to perform. Their finances and personal credit are going to be in shambles. But many of these small businesses are still going to be able to heal and grow if they're given patient capital, which is either equity capital or equity-like capital. And so I think we really ought to be taking a look at things now that we can be doing for more patient capital going forward. But I think the first issue of the day is really getting the PPP working. And with that, I turn back my time and answer any questions that you may have.
Great. Thank you. Appreciate it, Mr. Palmer. We're going to turn now to Mr. Hanna. Mr. Hanna, you're now recognized for 5 minutes. Appreciate your time. Mr. Hanna, if you don't mind just unmuting there so we can hear you.
There we go. Am I coming through now, sir? Thank you very much.
That's right.
I am Jay Hanna, Executive Vice President of Financial Services for Bank First in Oklahoma. We'd like to thank the members for inviting our comments today at the House Small Business Committee. Bank First is a state-chartered FDIC supervised super community bank with $8.6 billion of assets located exclusively in Oklahoma. We serve 60 communities in Oklahoma with over 100 service locations in both rural and metropolitan markets. And our portfolio of consumer households numbers over 200,000. And more importantly, for today's discussion, almost 40,000 business entities. While 65% of Oklahoma's population resides in the state's two major metropolitan areas of Tulsa and Oklahoma City, Bank First has over 60% of its asset concentration in non-metropolitan markets. Oklahoma is in direct parallel to the national profile of 89% of all businesses having less than 20 employees. The small community concentration of our bank, coupled with Oklahoma's high proportion of small businesses, has provided us the opportunity to be a focused SBA lender. The bank holds preferred lender status and has maintained that designation, also being the highest SBA producer in the state of Oklahoma for 27 consecutive years. Bank First fully embraced the congressional charge of rapidly addressing the immediate cash flow needs of America's small businesses caused by the COVID-19 pandemic. During the Paycheck Protection Program's initial offering, Bank First processed 7,000 loans totaling $829 million with an average loan size of $150,000. Notably, that represents one of every 5 PPP loans made in the state of Oklahoma. In the program's second allocation round, to date, we have produced over 2,700 loans totaling approximately $85 million. Of particular note is the average loan size, just under $32,000 for round 2. The program's mandate for rapid deployment required expediency. And to achieve this rapid deployment, the program was understandably governed by an initial interim financial rule, an IFR, issued on the day of the program's April 3rd launch that was very general. reliance upon the IFR's broadly stipulated assurance of 100% guarantee, and the safe harbor of relying on the customer certification of both eligibility and required financial information provided participating banks the adequate assurance to move forward quickly to serve small businesses. The introduction of additional refinements to the program, allowances and parameters through 9 IFRs, and by my count, and as of today, 12 Q&As, were mostly after-the-fact clarifications. While they brought clarity, they also introduced potential confusion for the bank's original interpretation of eligibility, forgiveness, and forbearance. In some cases, these incongruencies produced delays in application acceptance and ultimately in funding. When IFR certainty was unclear as to the administrator's intent, reliance upon the SBA's standard operating procedures often proved difficult. As we look forward, our concerns focus on the potential for negative impact, particularly on community banks who have shouldered the burden of implementation. If the cumulative impact of these after-the-fact IFRs and Q&A diminish the safe harbor implied by the initial IFR issued on April 3rd. Secondly, we are beginning to hear from some of our customers that there is a very real negative impact on their ability to qualify for loan forgiveness if the program's 8-week program proves inadequate to allow their business to reopen and restore cash flow. This is amplified by state and city regulations in combination with the reticence of consumers to re-engage. We now believe the resulting residual loan balances after forgiveness will far exceed the original expectation of PPP authors. It is reasonable to expect that business failure rates will exceed historic levels, leaving banks wholly dependent upon the SBA's guarantee. In such an environment, if standard SBA recourse actions are required as a condition precedent against businesses who cannot repay residual loans is contemplated, a flood of new and complex post-program issues and litigation will surface. On a national scale, such a process would seem overwhelming to the SBA as well as their constituent community banks. We respectfully encourage the administrator to bolster confidence in the program's granted guarantees as intended by Congress, design greater flexibility in the allowable use of proceeds, and consider an extension of the 8-week run period, and provide the ability to extend the subsequent repayment period to those remaining loan balances outside of forgiveness. I yield my time.
Great. Thank you so much, Mr. Hanna. We're going to start into the question and answer period, and I'll start off here with just a few questions and then turn it over to my colleagues. I wanted to start with Mr. Wilkinson. You, as well as pretty much everybody else, was just talking about the difficulties when it comes to loan forgiveness and the lack of clarity on that front in terms of the guidance needed to apply for that and understanding what is acceptable, what is not. I wanted to just go into a little bit more detail. You started to articulate the problems that this is posing for businesses in terms of their abilities to make judgments about how they proceed. And I wanted to hear just a little bit more of just concrete, what is the problem that is being faced by small businesses with the lack of this clarity, as well as what recommendations do you have to Congress to address those concerns? So I'd love to hear just a little bit more from you, Mr. Wilkinson.
Thank you, Mr. Chairman. We're hearing from our member institutions that their customers are fearful of what might happen to them now that they've taken out a PPP loan. They don't know what the forgiveness process will be like. We are hearing of a number of borrowers, even the smallest of borrowers, returning their loan funds out of that fear. We would have hoped by now to have sufficient guidance. And I want to make this crystal clear. While a lot of folks have directed their comments at SBA and the administrator, this is a program that is being directly managed by the Treasury Department. SBA is implementing it using their off-the-shelf 7A product, but every shot is being called by the Department of Treasury. So I hope that the Department of Treasury will get the final guidance out soon It is needed badly. It's past the required statute date. And I had hoped that last night we would have seen some of the guidance that we have been looking for. But as of right now, I just refreshed. It's still not there. Hopefully we will see that soon.
Appreciate your thoughts on that, and know that certainly many of us here on this committee are very aware of this. I'm hearing this from businesses in my community. I just had a conversation with a number of them yesterday, and this was the first thing out of the mouth of every single one of those small business owners. So certainly something at the top of our minds here. I wanted to turn to Ms. Williams just to get your perspective. You were giving some really insightful look into the issues of how we get resources to those that need it most, those that are often underserved. And you were talking about the community, the set asides for community lending and elements of that. So I wanted to just kind of dig into this a little deeper. If you could help us evaluate the extent to which the community lender set aside in the Paycheck Protection Program and the Healthcare Enhancement Act, how that was impactful and effective in getting loans funds to businesses that need it. And just would love to hear just a little bit more of your perspective on that.
The set aside, what it really allowed for CDFI serving these small borrowers was time. Because of the amount of demand that was in place from borrowers to get access to PPP and the rate at which funds were being deployed, it was really difficult for a lot of small lenders and our smaller borrowers to spend the time that was needed to both provide the technical assistance to help them develop the applications on the front end, and then also be able to actually get those applications into the system and get the approvals in a timely manner. So we had CDFIs telling us that their staff was working, until 3 or 4 o'clock in the morning, trying to actually, get loan applications in the system and get them approved. The set aside, I think, was incredibly helpful because we were able to know that we at least had some resources available that could be drawn down for CDFIs and MDIs. Part of the challenge for the initial $30 billion, however, is that the set aside also included basically almost all community banks and community credit unions because of that asset cap of $10 billion. And so we were still competing with a large number of other financial institutions to be able to get our loans approved in the system.
I wanted to ask you to build on that. There's some proposals in Congress right now that are saying maybe to establish some set asides based on the size of the borrower and not necessarily the designation of the lender. I just wanted your quick reaction to that, whether that might be helpful as well.
I do think that would actually be helpful because we know as CDFIs that we're primarily going to be serving those businesses that have 10 or fewer employees, and so I think it's just another way to get at the same issue, which is how do we get money into the hands of very small businesses. So even if the set aside is targeted towards the size of the business and leave some funds available for all lenders to serve those businesses, or if it's targeted towards CDFIs and minority depository institutions where their clientele happens to be a large percentage of those really small businesses, I think you'll be able to accomplish that. So we are supportive of a set aside, of course, that helps CDFIs, but also if it advantages those really small businesses, that's helpful too.
Well, I appreciate that. Well, look, I'm going to close out here. My time's up, but I appreciate your comments there. I want to turn it over to Ranking Member Hearn now. You're now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Hanna, from a lender's perspective, how have Oklahoma businesses reacted to the crisis and the response of the federal government?
The response has been good. When you look at the totality of applications that came from our rural markets and metropolitan markets toward Bank First, in toto, applications were just for Bank First were in excess of 8,000. We processed just over $915 million in loans. Our biggest dilemmas, of course, were mostly mechanically driven. The E-Trans system of the SBA is licensure driven. And I would point out to those listening that we're a community bank in Oklahoma. We have a centralized SBA department with 11 FTEs. On an average year, we'll generate somewhere in the neighborhood of 115 SBA loans for about $45 million. So we have pushed through over $900 million of loan applications through a system with effectively 5 licensure. We were able to secure additionals, but it was very painful, and through the process, we did not utilize it was a manually driven application process for us. There was no automation through API, an application programming interface. There were no flat file utilization. So we worked 24-hour shifts, 7 days a week, to be able to address the desires of small businesses in Oklahoma, which came to our bank in what seemed to be an unending pace between April 3rd and literally all the way through until the exhaustion of the first round.
I appreciate that. And thanks for being with us today as well. You all do a great job for Oklahomans, so thank you. Mr. Palmer, you touched on this, and I talked about it in my opening statement, and I really appreciate the time that you and I and others spent on the call earlier this week. But what improvements or suggestions do you have for Congress as we examine it and debate the future of PPP, and then as we retrospectively look at the success of it? What would you say that we should do differently? And I think you touched on some of them in your statements, but I'd like to get some clarity on that, please.
Sure. Thank you, Congressman. And I'd like to say also, I think that part of this story is the success and the importance of community banks. They've done an extraordinary job, and they deserve a lot of credit. The big banks did some good jobs too, but the community banks really did an outsized job, and it's really important to have regional small community capital providers. So thank you to them, and I think it's important on a policy basis that we're continuing to support community banks. I think there are a couple things. One, the clarity that we clearly need to know what these businesses, once they have the money, that they're allowed to use it. I talked to a small business just yesterday that wants to pay employees and bring them back, but they just aren't sure how that's going to work. We have to get that clarified and sped up. And again, I think the clarity of what's needed as far as this liquidity elsewhere, and it's terrified people. We, in advance of this hearing, we reached out to a bunch of small businesses that got PPP money that saved jobs in many of your districts, significant jobs. And many of those businesses are even afraid to tell us the story because they're afraid of getting beat up, and if they're going to have to give back the money and lay people off because they're concerned about this liquidity elsewhere test. And that's just profoundly and deeply frustrating. So getting that clarified would be really helpful. Also, I think it's worth noting that the affiliation rules have been an issue that have been a problem. And so as businesses that have small business investment company capital are able to access the PPP loans if they're small enough. And maybe that should be broadened out to be if you would otherwise qualify for a small business investment company investment, that you could access it. That would be helpful. And then I think clearly, as we're right sizing the loans, and again, there may be some mechanical challenges to this. I'd welcome Tony Wilkinson's thoughts on this, but businesses now know more about what they need and what they don't need. And we've encouraged all the small businesses to only take what you need and only apply it if you need it. But in many cases, they didn't know. In some cases, they still don't know. And so if we can make it so they can right size their loans downward if they need to, that might open up some extra credit capacity for more small businesses if we really are resource constrained, which appears we'll be.
Yeah, so just as a point of clarity in closing here, it seems to me before we look at how we can extend ongoing working capital, that to your latter point there, if we can get money back into the system, the program of people who are opening up at varying paces across the country, that would be very helpful. If we could slide the 8 weeks based on when governments are actually allowing you to open, that would be very helpful. Also, the 75-25 might allow for an extended amount of work run room on the working capital side, instead of us trying to ascertain what that number might be. Just a few little modifications in here could be very, very helpful in extending the run room of businesses beyond June 30th.
Absolutely. I'll mention one thing on that extending the 8 weeks is you have a lot of seasonal businesses that are open in summer, scale up in summer. And if they haven't done that yet, that 8 week may not work. So making that more broad or longer would allow a lot more seasonal businesses where this is really where they make or break themselves, have access to the capital.
Thank you. Mr. Chairman, I yield back.
Great. Thank you so much. Appreciate that. We're going to continue on to my colleague, Congressman Golden. So Congressman Golden, over to you.
Thank you, Congressman Kim. And I appreciate you putting this hearing together and giving us the opportunity to do a little bit of additional oversight, following up on last week's hearing. I thought I'd start with Mr. Wilkinson. I've held several roundtables with lenders in my district in the last couple of weeks, and obviously was hearing a lot of just similar concerns to what all of the panelists are expressing today. And you talked a little bit about concerns that the 7A program would be limited if the loan commitment cap for that program were combined with PPP. My understanding is that in the HEROES Act released in the House this week, there is language to make clear that that cap should be separated out between those two programs. And I just was curious if you'd seen that language and whether or not you felt that it would address the concerns, if some similar language to that's in the House bill would be helpful.
Yes, sir, we have seen that language. And yes, that is the intent of the language. We do have some concerns that the exact language did not accomplish that. We've sent in our comments into the committee so we can hopefully get some minor modifications made to that language. We are hopeful that is exactly what happens, that the 7A and the PPP authorization levels get bifurcated and that there's no risk whatsoever of a regular 7A program shutdown.
I appreciate that. I'd love to see that language myself, if you could share it with our office. I'm also hearing from lenders in Maine who are worried what might happen later on in the year as we're potentially seeing a more prolonged recession, in particular when temporary assistance that lenders and SBA have extended out to their clients, such as the federal government covering payment of SBA guaranteed loan costs for 6 months. We have the 6-month deferral of payments on non-forgiven portions of PPP loans and loan deferrals offered independently by private lenders. When these things start to expire, there's a lot of concern about what might come next. And I wanted to ask, what kinds of thoughts might you share with us about how big of a problem this might be down the road and what you think Congress and lenders can do together to address it?
Sure. All the things you mentioned are critically important. Specifically pleased about Section 1112. That is a very big benefit for the current 7A and 504 borrowers. But you're exactly correct. As you might imagine, the conventional credit box, if it is not closed, it is getting very close to being closed. A lot of borrowers are going to be faced with negative trends. And it's going to make it very difficult for them to access credit like they had been. So we view the 7A and the 504 loan programs and the SBIC programs to be once again front and center. They're going to be the primary source of capital for small businesses as we come out the other side of this crisis. We are hopeful that Congress will consider the passage of items that were included in the Recovery Act, higher guarantee percentages, fee waivers. Those items are included in the HEROES Act, and thank you for that. I think that'll be critically important as we move forward, and will provide us some tools that we can continue to help small businesses come out the other side.
Thank you very much. And I've got about a minute left here. So just for anyone on the panel, as we're waiting to hear, and it should be coming any day now is what we've been told. And I hope that they do get it out there quickly for the Treasury and SBA, some more clarity on the forgiveness side of things. I've heard it described as we're now in the eye of the storm, as many businesses have this assistance, but now they're going to be looking for loan forgiveness. And I wanted to ask, do you think it would make sense for us to formalize a tiered approach to PPP documentation and auditing, in which the smallest loans have a lighter burden, and the larger the loan, the greater the scrutiny?
I think you're going to clearly have you're going to have to prioritize how many loans you're going to look at. You're looking at 4.3 million. You can't go through them all. It's clear that they're going to look at the bigger loans first, and that makes sense. But I do think that just having some clarity about what they're going to audit, what small businesses are going to have to document, what type of injury, because that's what they're trying to figure out. If they can document what the injury was and how they used the money, use it for the right terms, it really doesn't matter. We're comfortable with that. They will inevitably go to the larger borrowers, doing some of the smaller. That's perfectly fine. I think that's reasonable. I will mention on your previous question about the loan forgiveness, one of the things I think ought to be looked at is on the tax code. If businesses get their loans forgiven in any way, it becomes taxable income. And so not just for the PPP, but just for any loans and modifications. So I think you ought to be looking at, as we're rewriting the tax code, some provisions where we're not penalizing businesses, that their loans are forgiven, that they're now paying income tax on that loan forgiveness is something else. But I'll turn it back to anybody else for any other comments.
Well, thank you to the panel, and Chairman Kim, thank you as well for the opportunity, and my time has expired.
Yeah, thank you so much. Appreciate that. Some very helpful insights here. I want to turn it over. We're lucky enough to have the ranking member of the full committee here with us, so I wanted to turn it over to our ranking member Shabbat for his questions. You're recognized for 5 minutes.
Thank you very much. And I'll begin with Mr. Palmer. Mr. Palmer, as you know, SBIC-backed small businesses have eligibility under PPP. From your perspective, how have these businesses navigated this loan program? And are you seeing signs of success? And what modifications would you like to see made?
Thank you, Congressman. SBIC-backed businesses are some of the highest growth, biggest job-creating small businesses in the country. So these are sort of the seed corn for the economic recovery as we come out of it. Having the ability to access those PPP has been very helpful for those that have needed it. Not all that have needed it. All the SBICs have looked at their small businesses and told them, if you don't need the money, don't take it. If you need it, only take as much as you need. This is the time to be a good citizen and not just a good businessman. The two are connected. So I think it's been very helpful as that goes, and I think you're saving a lot of jobs. A number of them are across Ohio, across Kansas, and others. I do think that if it's allowing for PPP access for businesses that otherwise wouldn't qualify because the affiliation rule, if they would otherwise be eligible for an SBIC investment, would be helpful because because SBICs can't get to every single high growth company that's out there. So we can do that where they still have to be small, employees, they have to be inside the United States, producing inside the United States. But if we can make sure that all companies that are creating jobs are able to be maintained, I think would be helpful.
Thank you very much. And my next question I'd address to Ms. Williams and Mr. Wilkinson. Over the last few weeks, I've had the opportunity to join literally dozens of members of Congress on conference calls with their local businesses and their lenders. The topic of guidance from the SBA, from Treasury, was raised quite often on those calls, I can assure you, and it continues to be raised. From the lender's point of view, when do lenders need what is it that they would most prefer to have clarified under additional rules to come out on the PPP in order for it to be successful?
I was going to let Mrs. Williams go first, but I'll take a crack at that. First of all, we would have loved to see guidance on day one. We typically would operate an SBA program using a program guide. We had asked in a joint trades letter, as soon as the CARES Act was going to be passed, that the Department of Treasury and the SBA issue clear, definitive guidance so that we knew what the rules of engagement would be. And today, still don't have that program guide. We'd asked for a note, sample template. Treasury chose not to provide that. We asked for a blanket loan authorization, which sets forth the terms and conditions. Treasury opted not to provide that. Instead, they have opted to manage by a rolling series of FAQs that change nightly. Lenders have to go look every single day, see what has changed, sometimes multiple times a day, to see what new has been posted. And in fact, there was a new FAQ posted this morning. And that's just a real difficult way to manage a loan program. So you really never know what the rules of engagement are. You're always wondering what's coming next.
Thank you. Ms. Williams?
Yes, I would also just add for CDFIs, it's been confusion from the beginning, whereas we didn't even really understand from the outset whether we were going to be eligible lenders. And then there was a very long lag time to getting that initial guidance around what those qualifications would be. And so now that we do have more clarity around, the loan volume threshold, the concerns have shifted a little bit into now for our borrowers, what is the guidance that I think we've spoken a lot about for forgiveness and how to make sure that, the borrowers are able to actually access that. So our concerns have continued to shift, but I would just echo Mr. Wilkinson's comments that, it's been a moving target and the guidance changes at 8 or 9 p.m. at night. and we're left scrambling, trying to understand, what it means for our lenders, where, we really could have benefited from some certainty at the outset.
Thank you very much. Mr. Chairman, I cannot see how much time I have left. Do I have any time left?
Yeah, about 30 seconds left if you like.
All right, I'll be real quick then. Mr. Hanna, get everybody in. Your bank and other lenders are prepared to assist small businesses through the loan forgiveness process, especially in light kind of the lack of timely guidance that we've had?
Yes, sir. We view that as obviously our responsibility under this particular program. And echoing the comments of the other panelists, it is imperative that we have clarity in describing to our customers what the rules of forgiveness will in fact entail. For us mechanically, it's about what the requirements will be for submission to the SBA. As I mentioned earlier, utilization of the E-Trans system, very limited licensure exposure. If there is a tsunami of documentation that will be required for uploading or to be held by the SBA, that will be a major time constraint for community banks. As I mentioned earlier, we were forced to operate in 24-hour shifts just to be able to submit for approval into the E-Trans system. So if forgiveness takes on a burdensome profile with regard to documentation, this will be an extended burden on community banks to be able to comply. We need that clarity. We need simplicity to be able to serve our customers well.
Thank you, Thank you. Mr. Chairman, I yield back.
Thank you so much for your questions there. I'm going to turn it over to my colleague, Congresswoman Davids. Over to you for 5 minutes.
Thank you, Chairman Kim, and thank you to everybody for taking the time to participate here. I know there's been a lot of frustration and confusion around the rollout of these programs, particularly of the Paycheck Protection Program. And as we were just hearing, in fact, I'm going to follow up on Mr. Shavitz's line of questioning here, that frustration and confusion around the rollout that has a lot to do with the lack of clear guidance, whether it was guidance to be able to close these loans or the guidance now around the forgiveness portion. And Mr. Hanna, I appreciate all your comments. I think I'd like to hear also from, Ms. Williams, if you have any additional comments about the guidance and the need for clarity around the forgiveness portion. I know a lot of the small businesses I've been hearing from, and we've got some CDFIs doing this kind of work in, here in Kansas in the 3rd District. I'd love to hear some information from you about what that's looked like on the ground. And then as a follow-up, so that I don't take another 2 minutes to ask the next question is, could you all maybe provide some commentary on what it's been like to try to give feedback or reach out to Treasury or the SBA? Because I think that that's particularly one of the reasons that I felt it was so important to actually run for office, is because I think that we need people who are able to listen and take that constructive or critique into account when creating these programs.
Sure. So I will begin. So for CDFIs and our customers, and I think a lot of the other panelists have alluded to this, the borrowers are scared. They are afraid that they are going to be on the hook to repay this money when they thought it was going to be forgivable. And for the customers that we're serving, they are already pretty financially distressed. They're smaller, they have less revenue, they don't have a lot of resources to get access to other capital. And, adding on an additional layer of debt, even though the terms are actually quite favorable when you think about 1% over 2 years, they are afraid that they're going to come out of this with an additional debt on their back that they cannot afford to pay, and they will never be able to recoup the revenues they've lost to be able to, manage that debt service. So that's their primary concern. And we don't have good answers to give them right now because it's unclear. We don't know what to tell them because we're still waiting and waiting and waiting. I will say, OFN has spent a lot of time engaging with Treasury. We're sending letters to the SBA and the Treasury all the time. And sometimes it's as though we're hitting a brick wall, but there have been occasions where we have directly engaged with the Deputy Assistant Treasury Secretary and have gotten on calls to try to explain our positions. The problem is just that it takes a little bit too long for them to make a decision to change things that we're asking for. We don't have a lot of time to help these business owners right now, so waiting 2 or 3 weeks to update guidance is pretty unacceptable.
I'd add to that. We need to emphasize the fear of the small businesses, not just for can it be forgiven, but also they're being threatened with going to jail, that these are crimes if there's credit elsewhere. And the idea that you would borrow money and bury yourself in debt to pay people when you're not having revenue is just not something any small business is going to do. This program is specifically designed to subsidize non-economic behavior of keeping people employed that are low and moderate wage employees. And so it's been very difficult to try to get folks that are scared to hold on to that money and use it because they just need some simple clarity. I get how obscene it is that the LA Lakers took money. That's just indefensible. But in the process, there's a bit of an overreaction, and I get it's great politics for some folks to beat it up. But really, the SBA has done a great job. They've been very accessible, but they've tried to have a unified voice, and I appreciate that. But they need to have a unified voice that small businesses are okay to use the money for the stated statutory purposes that it was put forward and to be forgiven.
I would comment that the avenues and channels of retail have evolved to a point where we have seen here in Oklahoma both environments, those that are fearful of draconian interpretation of whether they were eligible, that forgiveness would be adequate. To date in our company, we've had $31 million returned to us. That's over 80 loans. There are no publicly traded companies in it. These are small businesses. On one side, we've seen manufacturers that traditionally do business with big box retailers, and they were very fearful at the very beginning of the pandemic that due to shelter in place orders in communities that those retail entities would be shuttered, and they were. They were very pleased to discover that customers and consumers found them online. And so they returned the money because they simply did not require such. I would also address your question about communication with the administration. Dottie Overall is the district director here in the state of Oklahoma, and she's been highly communicative with us at all times. We were able to reach her. The unfortunate status was that she had about as much information as we did. While very receptive to listening to our concerns, the lack of answers, the lack of clarity, the lack of satisfaction that we were in fact aggressively moving these monies out and doing so in appropriate fashion is simply not there for us.
Thank you. Thank you for that, and thank you for the work you all are doing, and I yield back.
Great, thank you so much. We're going to continue on here, so I'm going to turn it over to Congresswoman Radewagen. Over to you for 5 minutes. Congresswoman, if you'd like to make a question, you can unmute and make the comments right now. If you'd like.
Can you hear me now?
I can. Thank you so much. Over to you, 5 minutes.
Talofa. Thank you for participating in today's forum. And I want to thank Chairman Kim and Ranking Member Hearn for organizing today's event. Your comments have been very insightful as we look to PPP and its implementation. The Small Business Administration's Paycheck Protection Program continues to provide vital help to the country's small businesses. Unfortunately, the first round largely went to the swift, well-banked, and larger small businesses, as you know. But with input from myself, the other territories, and other underserved communities, we succeeded in making modifications to the PPP. This ensured smaller institutions and micro businesses were given much needed access to their small community banks. My home of American Samoa has only 3 banks, none of which operate in the continental United States. We have only one bank that was an approved lender during the first round of PPP, but recently a second has been approved. We only had a couple of approved loans in round one for only $500,000, but nearly 100 for over $5 million, and rising in round two from last Friday's report from SBA. And we're a remote island community, but the modifications in round two have certainly been helpful to our small businesses. Some of our businesses are still figuring out the PPP, but many have received great help through our local SBA Small Business Development Center, affiliated with our local community college. And the SBA has been very responsive to our small community needs. The $60 billion that Congress set aside to small banks and underserved banking communities like ours in American Samoa has been a success, but the demand is still there. Which leads me to my question for all of the panel. How do you see the differences between the implementation of the first and second rounds of PPP as it relates to the smaller underserved communities elsewhere in the country? And do you see the level of loan demand being met for smaller, more rural banked communities around the country? And kind of as a follow-up, what kind of future need or changes do you think can improve the PPP, especially for those underserved small businesses communities? Mr. Wilkinson, you want to start?
Sure, I'd be happy to. I think the first thing we need to look at is just exactly how the loan dollars were spread around. In the first round, 74% of the units were for loans under 150,000. And in that initial report, that is the only breakdown. I can't see below the 150. But in round two, loans under 150,000 are up to 91%. And in fact, over 73% of the loans are for less than $50,000. So I think there's been a strong uptick in the number of the smaller transactions in round two. But I don't think they were excluded in round one. I think that the numbers show that a significant number of borrowers did in fact participate in the first wave. I think the set aside helped. I think the special afternoon for the smallest of lenders helped make sure that they had easier access into E-Tran. I think those all made sense. But I do think that the smaller dollar borrowers are participating. And in fact, if you look at the 50,000 and under level in round two, the average monthly payroll is less than $7,000. So we are reaching down to the 1, 2, 3 employee levels. I do think some of the ways that could help is if we consider some flexibility on the 75-25 rule, where Treasury has decided that not more than 25% of the forgiven amount may be for non-payroll costs. The CARES Act that was passed by Congress did not have that as a mandate. And I do think that would be one way that we could look to make this program a little more flexible. Right now, a one-size-fits-all really doesn't work because there are many businesses that won't make it to the other side of the crisis if they have to use 75% of the proceeds solely to pay payroll. There are many small businesses who have other monthly expenses that are greater than 25% of their average monthly overhead. So I think that is a key consideration that we look at.
Ms. Williams?
Yes, I would agree with.
Hello, can you hear me?
Hi, yes. I agree with what Mr. Wilkinson said. I do think we've seen an improvement in round two of actually getting access to these smaller businesses. I think the set aside really helped because it actually allowed for some additional time for smaller lenders who maybe didn't have as much familiarity with the E-Tran system, help actually get those loans through their queue and processed. The small window for small lenders was very, very helpful as well. And I think I agree that, a little more flexibility on that 75-25 split is going to be helpful going forward as we get a clearer picture of what the actual impact is going to be on these small businesses. They're going to need more flexibility than what's currently written into the interim rule.
Mr. Hanna, followed by Mr. Palmer.
We're gonna have to unfortunately pause it there just because we ran out of time here. I want to make sure we keep on track, but appreciate your questions on that front. I wanted to turn it over to Congresswoman Chu for your 5 minutes. You're now recognized.
Thank you, Mr. Chair. I'm so glad that the Paycheck Protection program has been improved with a set aside of $60 billion for smaller lenders. And I believe the HEROES Act will improve the process even more with the extension of the time of loan from 8 weeks to 24 weeks and extending the deadline of the loan from June 30th to December 31st and eliminating the 75-25 rule. And one great improvement that the SBA has finally provided, which was a mandate of the CARES Act, was to provide official translations of the COVID-19 loan applications. They did it this week in 17 languages, but there is more work to be done because the translations of the guidance has been done, but not of the applications themselves. So I urge the SBA to get these done. And I want to talk about another issue of the CARES Act. Ms. Williams, the CARES Act expressed the sense of the Senate that the SBA administrator should issue guidance to lenders and agents to ensure that the processing and disbursement of covered loans prioritize our underserved and rural markets, including veterans and the military community, small businesses owned and controlled by socially and economically disadvantaged individuals, women, and businesses in operation for less than 2 years. But despite this direction, just last week, the SBA Inspector General found that no such guidance was issued to lenders, and SBA's failure to include demographic information on PPP applications means that the agency may not be able to track dispersed funds. So, Ms. Williams, can you tell us what the consequences of this lack of guidance, and about any steps that your organization has taken to address this?
Sure. The lack of guidance and the lack of demographic data being available on where these loans are actually going means that we can't properly assess and evaluate the program. And so we're left to sort of patch together from our own knowledge. Okay, well, if we know that businesses owned by people of color tend to be smaller than a certain size or have a certain revenue size, and we can sort of extrapolate from there. Well, maybe they're reaching these communities because we've made loans of less than $50,000 or the average business employee size is 8. But that's not the same as having data that actually definitively tells you who the loans are reaching and where they're going. And so we really, need to be able to see that guidance. CDFIs and OFN, we collect our own data, and so we can really understand what's happening on the ground with our own borrowers, but we do not have that system-wide picture of what's actually taking place right now. And that's really unfortunate to assess the impact of the program.
And thankfully, the HEROES Act mandates the collection of this data once again on a timely basis. Mr. Wilkinson, my office has received countless inquiries from small business owners in my district who are desperate to seek an update on their PPP applications. These business owners need information and status updates so they can make plans to save their businesses and keep their employees on the payroll. Under the CARES Act, SBA was directed to disperse PPP funds within 10 days of loan approval. But I've heard too many reports of delays, and I find this deeply concerning. Can you explain how long a typical client of yours should expect to wait for both loan approval from your institutions and then disbursement of their funds from SBA? And what capacity do you have to provide status updates to applicants when there are delays in either their loan processing or in disbursements from SBA?
Sure, there's a couple answers to that question. First of all, the sheer magnitude of loan applications was not anything we have seen before. Second, the 10-day requirement was not put into place until well after the program had started. And as you might imagine, many banks had customers lined up in a long line trying to get their application in, making sure that they were included in the first wave. So there was a speed to market, if you will. There was the need for speed. It was prioritized above all else by Treasury and SBA and then the lenders, trying to make sure that as many borrowers as qualified we could get included. It was subsequent to the start of round one that the 10-day rule was put into place, and is now 10 days for the banker, the lender, to provide the documents to the borrower, and another 10 days for them to return the documents. So we have 20 days from loan approval to actually get the loan funded. And so I do think that a lot of lenders have now shifted. As you might imagine, it was all hands on deck trying to get 4.3 million loans approved. Now lenders have shifted that workforce over to closing and funding as quickly as possible. And most of my lenders tell me that they are able to comply with the 10-day rule.
Thank you. I yield back.
Right, thank you so much. We're going to continue on. Congressman Stauber, we're going to turn it over to you for 5 minutes. Over to you.
Thank you, Mr. Chair. Thank you, Ranking Member Hearn, for giving us this opportunity. I really appreciate this discussion. And I think it was Mr. Palmer who made the comment about the ability that our small banks put forward in making sure these loans were given out and worked with our small business community. I want to echo that. Our small business community and the lenders across our community lenders did a fantastic job. Just for reference, the state of Minnesota put out the highest, the third highest PPP loans per capita, and that meant that our rural lending institutions and community banks did a wonderful job with, I may say, a little or not much guidance from the Small Business Administration because of the timeliness of it. I just have a couple of questions. We talk about the PPP loan origination fees. I think we discussed it a little bit. I will say that some members in my community are concerned about the timing of that. And I know I think you talked about it earlier, but just so the origination fees, the banks are starting to, require some of that investment, that capital back to them. And then we need to, and I think you would all agree with this, and I want you to comment on this, the flexibility that is required of these PPP loans. I think the Small Business Administration, we have to be very fluid on this. Mr. Palmer talked about seasonal work and seasonal employees. In northern Minnesota, this is vacation time, and there's resort owners, houseboat owners, campground owners, fishing and hunting, sports, for example. There's seasonal requirements, and I just want to know, how hard are we going to push the SBA on allowing that flexibility? And Mr. Palmer, I'll start with you.
Thank you, Congressman. First of all, I think the SBA has done a really good job, and Administrator Carranza has really done an excellent job in a very difficult situation. But I do think it probably does require some statutory changes to allow that broader time frame for those seasonal workers. When this law was written, it was written as the hurricane was sort of coming upon us when we didn't know it was going to last. So it's now lasted longer than I think any of us expected, and certainly has been worse than I expected, and I knew it was going to be bad. So I think putting that in the statute of giving that flexibility would be helpful. And given the fact that every small business is a little bit different, it's hard to put them into a single basket. Maximum flexibility for the use of the capital would be helpful.
And I think, thank you for your comments, Mr. Hanna. Comments?
From your question with regard to fees, our avenue for being able to collect our fees is through our core processing system, PCFS, which is a long-time national processor that interfaces with Colson Services, the official interface with SBA. We submitted our report as required under traditional SBA rules within the first week of May. It was an 800-page report. At the same time, we then heard later on through another set of communications that 1502 report to the SBA may not be accepted. So I know I sound like a technology and mechanical wonk here today because we've been working on actually making these happen, but our burning up time to repetitively either resubmit or be locked out of systems burns up more time for us to be able to interact with our customers and to answer their questions and help to draw away their concerns from that they have from the program.
I appreciate those comments, and I'll just my final thoughts are we need to continuously allow the flexibility for these small business men and women. They are the engine of our economy. And also, I think it's an opportunity to look at some of those redundant rules and regulations in the lending institutions themselves and what the SBA has traditionally required. We're seeing some of those the redundant rules and regulations go away so we can get these loans out quicker. I think it would behoove us to push the Small Business Administration as a committee on asking them what and the recipients of the loans, what can we do to make that access to capital easier as we go down the road. So, and I see my time's up. I really appreciate the opportunity, Mr. Chair and Ranking Member Hearn. Thank you.
Thank you for your questions. I appreciate it. I'm going to turn it over to my colleague, Congressman Schneider, for 5 minutes. Over to you.
Thanks, Chairman Kim. I want to thank you for having this hearing and our witnesses for joining us today. I appreciate you sharing your perspectives on the PPP program. Take a moment first. I want to thank the committee chairwoman, Velasquez, the ranking member, for all the work this whole committee is doing and exercising oversight by having these forums, and looking forward to having a real committee meetings hopefully in the near future. The Paycheck Protection Program has already dispersed hundreds of billions of dollars to businesses, serving a lifeline to small businesses across the country. But as our panelists have shared today, the program has not worked for everyone, and there are still many problems leaving small businesses and even some of our larger small businesses in doubt of how to proceed forward. I want to talk a little bit about the improvements made with the HEROES Act that was introduced yesterday, and thank the chairwoman for her tireless advocacy for small businesses throughout the negotiations and as we go forward. But gaps still remain. As the SBA implemented the CARES Act, I heard and continue to hear from businesses in my district, in particular from the hospitality and service industries, but not exclusively. They're concerned about the tight framework, the 8 weeks to use the PPP loans. Under the HEROES Act, this 8-week period will move to 24 weeks, giving necessary flexibility to our businesses in our community. I also want to thank and commend the chairwoman for working to include all nonprofit organizations as eligible for SBA assistance. Like many members on our committee, I've heard from organizations of all sizes in our community and all scopes, from local chambers to organizations that provide vital services but have more than 500 employees, who are desperately anxious to have access to the PPP loans. And finally, I want to extend my appreciation for the hold harmless provisions within the HEROES Act, those amendments to PPP. It's important that lenders who act in good faith aren't penalized. However, I think the language would not be necessary if the SBA issued timely, specific, and clear guidance on PPP loan forgiveness, as has already been mentioned in this forum. 3 weeks ago, I was on a call with the SBA administrator and other members of this committee when she said to expect loan forgiveness guidance in short order. And it would likely be that very same week. Here we are 3 weeks later, and still we don't have the guidance from the SBA. I think, as was noted earlier, there have been from Treasury 9 interim notices and 12 series of frequently asked questions, oftentimes contradictory. That's creating confusion for our businesses and our lenders at the exact worst possible time. We need that clarity, and I hope we can get it soon. So with that is just general remarks. Maybe I'll turn to Mr. Hanna first. And again, thanks to everyone for sharing your thoughts. But as we look forward, as we try to fix the glitches, with anything this large, there are going to be stutters out of the gates. But what do we have to do to help lenders like you, and I'll guess I'll open this up to everyone on the panel, to make sure that it is easier for you to provide the assistance we all together want to give to our small businesses as they navigate through this crisis?
Well, we have said it over and over again. It's obviously the clarity and a coalescing of the standards of acceptability through this program. As was mentioned earlier, 9 IFRs, 11 today, 12 Q&A sessions that have almost like the peeling of an onion continue to bring about clarity and confusion at the same time. We need to finally draw this together where we know exactly what it is that we're supposed to be doing and helping these customers to move through the cycle a cycle that apparently, at least here in Oklahoma, is going to be inappropriate. 8 weeks, while it was certainly a good projection of what might happen, apparently the choreography between the pandemic and between the reality of what's happening with consumer activity and with small business, simply not there. So the extension of time, flexibility, absolutely necessary. And once again, particularly for small community banks. Now, here in Oklahoma, we have 200 financial institutions. Half of those institutions have less than $100 million of assets. And in many cases, they were not active SBA lenders prior to this process. We are the highest producing SBA bank in the state of Oklahoma for 27 consecutive years, and we only have a staff of 11 people. I've had to conscript over 70 people to be able to meet the 24-hour shifts just to upload into the system to get these loans approved in an adequate and expedient period of time to be able to serve small businesses. I can only imagine with our inability to genuinely understand all the intricacies of these IFRs and various instructions, what banks that are not involved in SBA regularity, what they must have gone through. Because in many cases, IFRs where they are uncertain or unclear would revert back to standard operating procedures of the SBA. And now we're talking about thousands of pages that more than likely was far outside of the expertise of many of the community banks that have shouldered the burden, not just here in Oklahoma, but across the entire United States, and seeing that these funds go to small businesses. Clarity, simplicity, accessibility. Those are the things that we need to be able to be successful in helping this country get back on its feet.
Thank you. I'll say, as a former businessman myself, those are things you need in normal times. These are extraordinary times and become even more important. And I don't know how my time is, Mr. Chairman, but if a chance, I'd like to ask Ms. Williams to talk about it from her perspective.
Unfortunately, we're going to have to wrap up here.
I understand.
We've been going on for.
Thank you. I appreciate the time. I yield back.
I appreciate it. We can always keep this conversation going. And look, the work that we've been doing on this committee is just 100% laser focused on delivering for the small businesses and getting through this crisis. Ranking Member Hearn, I wanted to turn it over to you if you had any final remarks you wanted to say before we close out here.
Thank you, Mr. Chairman. Thank you, everyone, for being on the virtual meeting today. And I really appreciate all the expert testimony from everyone here, sharing your perspective. And as the chairman has said, and I've said a number of times, this is a great committee to be on, because, and also during this time when we need to be very bipartisan in our approach. This should be about leadership and about getting our small businessmen and women, helping them stay in business, to keep people in jobs so that we can return to our strong economic health whenever this is over. Again, as we've all talked about, the PPP program, yes, it has faults. It's easy for us all to Monday morning quarterback a lot of the things, and we're not here to be very critical. We're here seeking solutions and possible answers on how we can continue to make this great. And we really appreciate all of you all coming on today and giving us your expert testimony and allowing us to ask you questions, and you giving us such great answers. So thank you so much.
Thank you. Appreciate it. I just want to echo just the thanks to the panelists as well as my colleagues for jumping on and having this discussion. When I've talked to a lot of small business owners here in my district in Burlington County and Ocean County, whether they are ones that survived the 2008 financial crisis, or that they survived Superstorm Sandy and the devastation that they put forward, they often talked about this line saying that small businesses are always the first to get hit and the last to recover from these types of crises. And I've been thinking a lot about those words with regards to what we're facing now. In some ways, it's an even worse situation here, where they're the first to get hit, but it's yet to be seen whether or not they can recover from this. And it's very much at stake here. It's a way of life in our country in terms of small businesses and our commitment to Main Street. And that's what's on the line. I mean, there's no way to be overly dramatic about it. These are unprecedented times for small businesses from corner to corner of our country. So in this way, I appreciate all of us sharing that commitment, sharing that mission, working across the aisle and trying to get things done. So with that, I will conclude this this discussion, and again appreciate everyone and the staff of this committee and everyone else who helped put this together. Thank you, and please stay safe and healthy.
Thanks, everyone.
Thank you.